Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and success strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is sponsored by BOMI.org. That's B-O-M-I. They are the industry standard for facilities and property management education. Check them out at BOMI.org. Well, we have another very interesting show for you today. We're going to talk about financing. And I think one of the things to think about financing, is it a signal or a catalyst of what is coming down the pike? You know, what everybody's concerned about, how long this cycle's going to last. What are rates going to do? What is the economy going to do? Where are we in the cycle? And I think when we look at lenders who obviously take a very close look at the market, it might give us some signs. So please welcome my guest. It's Tom Fink, and Tom is Senior Vice President and he's Managing Director with TREPP, and he's joining us on the phone. Tom, good to talk to you again.
Michael, it's great to be on the show again. Thanks for inviting me.
Well, thank you, Tom. And if you guys haven't checked out TREPP, their website's TREPP, TREPP.com. Check them out for all their services. And Tom, you know, as I talked about in the opening, you know, I think a lot of people are concerned about where we are in the cycle. What are rates going to do? You know, when you've been in this business for a long time, watching the financing end, especially of commercial real estate. Is there any correlation between what lenders are doing and where we are in the cycle, and do lenders underwriting and things kind of impact the market?
I think lenders can impact the market, and I think there has been a lot of impact over the last couple of years, particularly on the construction side. But what I find fascinating is that regardless of where, the Fed may lean or the regulators may lean on one type of lending, there's so much capital available in the market, both debt and equity, that new financing vehicles come into play, and a project that has a determined equity sponsor is going to find the financing it needs over time. Financing, the drying up of capital has not in general been the cause of the end of any real estate cycle. In fact, if we look at the last recession, the big financial crisis of 07, 08, lenders were actively lending right up until the point where, the market just sort of imploded on itself. And that was particularly true on the construction side. People were extending credit on the single-family side way past the point where market fundamentals supported some of the valuations that were out there.
Well, are lenders going to be more cautious this time, or are our memories have evaporated?
I think people are trying to be disciplined. All right, I will give them credit for that. But on the flip side, you have very sophisticated borrowers. There's a lot of institutional capital on both sides of the table, both asking for money and lending money. So you're going to see for certain large borrowers, you're going to see some pressure on terms and conditions. And I think you're seeing that in the market now. There are some covenants, there are some pushing of some of the debt service numbers, but I don't think anybody wants to be caught with poorly underwritten projects when the next recession hits, regardless of how mild it may be.
Right, and you mentioned some of these new sources. So is that an impact, and is that a concern for traditional lenders as they're trying to do what they do? Is it making them push debt coverage ratio or loan to value or some of these covenants? Is it really impacting them that there's more sources for capital today?
I think right now a lot of the new sources of capital are filling a gap where, because of the pressure from the regulators to hold down the amount of construction and development lending, which was a big source of the problem the last go-around. That lending is what's winding up in some of these new alternative vehicles. And the people that are running them are, extremely sophisticated and are veterans of the last couple of real estate cycles. I mean, I look at the senior finance people at some of the, the mortgage REITs that are lending in the commercial real estate space, some of the PE firms that are lending in commercial real estate. And these are people that have been around a while. They've seen a couple of cycles. They're making what they think are good loans right now, but they have the chops to do the workout if it absolutely becomes necessary.
Yeah. And I think they're also aware with that much experience, and I assume they're all experienced if they're lending money on commercial real estate, that if this cycle does come to an end, it's not going to be like the last one.
Yeah, I don't think we clearly don't have the overbuilding that we had in the 90s, when in the 80s, when the Japanese were pouring money into projects and and big office buildings were going up in non-traditional markets. That kind of construction hasn't taken place. I mean, even you look at New York City and Hudson Yards, which is, a massive real estate development. I think the number I saw is it's adding a total of 2% to the supply of commercial office space in the city. It's adding a bunch of housing units, but then you have Amazon announcing that, they're going to take up a big position in Long Island City. So that is going to be absorbing a lot of that space. I think there's going to be plenty of jobs in New York. I think there's going to be plenty of demand for commercial real estate. I think there's going to be plenty of demand for housing. It's a question of whether we can deliver the supply at all the different price points that need to be out there.
Yeah. Well, let's talk about regulations. Are the regulators maybe being too tough on some of these lenders? I talked to Brian Bailey with the Fed, and sometimes I know it's their job to be cautious, but are they overcautious looking back at what happened in the last cycle? As you mentioned, we have a strong economy. We don't have the overbuilding. Do we have too much regulation? Is it just right? What are your lender clients telling you?
Well, the lenders will always, my lender clients will always tell me there's too much regulation. I mean, that's one of the reasons you have some of these alternative capital sources coming about is they're regulated under a different regime, and without the same level of mandated capital, so you can adjust your capital to reflect the risks that you think you're taking in the business. Is there too much regulation? Not enough regulation? I always think regulators try to do too much. They try to cover every potentiality, and quite frankly, people are creative. They're going to look. The more complicated the set of the rules, the more people you have invested in finding the loopholes in it, and that's what people will look for,
right.
And that's what people will try to go around. And if you can't get money through a traditional bank channel, it's going to go elsewhere. That's why we have the whole alternative finance business. There's a demand for capital. The cost of regulation makes the capital too high, and by using a less formal regulatory regime, you're able to better match capital to demand at a more reasonable price.
Right.
Do people go overboard in the other direction? Of course they do. Mm-hmm. Remember, lenders are there to lend money. They're not there to buy treasury bills. Right. People that run equity funds for real estate are there to buy real estate. They're not there to sit and buy treasury bills. Right. So there is an incentive in the structure to put money to work. I think the hardest thing for a lender or a property investor is to say, you know what, the market's too rich, I'm going to sit on the sidelines. Because, until the market decides, things are overpriced, we're going to have a correction, you wind up trailing your benchmarks.
Right. We're talking with Tom Fink with TREPP. And Tom, let's talk about the elephant in the room. That is rates. What are you hearing? What are you seeing for rates going into 2019? What do you expect?
Well, I think your rates are going to continue to drift up. I don't think you're going to see a huge spike up because I think, to be perfectly honest, I think the Fed's afraid of being accused of triggering a recession by raising rates too quickly and too high. When you look at the current 10-year Treasury, I think that, people's view is skewed by when they came in and started working. and when they first came into the market. Look, I've been, like you've observed a couple times, I've been doing this for more than a year or two. But, I remember when, interest rates were 16, 17%, and business was still getting done. People were finding a way to make it work. So the current level of interest rates, if you take a long-term view, is reasonable. It's 5% higher than 4.5%. Sure, it is. Does 50 basis points make a difference on some marginal loans? Yeah, it will. But the question you have to ask yourself is, can I actively step away from this loan? I mean, if 50 basis points makes or breaks a loan, you always have to ask yourself, should I be making this loan in the first place?
Right. Or should you be borrowing the money in the first place?
Yeah.
Right. All right, we're going to take a short break. When we get back, I want to ask Tom about what he feels about the length of this cycle, where are we? And then also talk about some of the sectors. So some people are concerned maybe there's some overbuilding in certain areas. We'll get to that after the break. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.